On a practical level, saving involves putting aside money today for use in the future. It's what economists describe as foregone consumption. In other words, rather than spending all your money, you tip some into a savings account for another time. Savings is a sensible starting point in investing because it provides the funds you need to purchase a range of different assets. However, investing goes one step further, helping you achieve personal goals. Welcome back to another episode of Hustler's Headquarters. Subscribe now, so you never miss any of our uploads as soon as they're available so you can start your journey. Let's get started with this episode. 1. Stocks. If you are ready to start investing in the stock market but aren't sure of the first steps to take when investing in stocks, you've come to the right place. It might surprise you to learn that a $10,000 investment in the S&P 500 index 50 years ago would be worth nearly $1.2 million today. Stock investing, when done well, is among the most effective ways to build long-term wealth. Diversification is considered to be the only free lunch in investing. In a nutshell, by investing in a range of assets, you reduce the risk of one investment's performance severely hurting the return of your overall investment. You could think of it as financial jargon for don't put all of your eggs in one basket. In terms of diversification, the greatest difficulty in doing this will come from investments in stocks. With a $1,000 deposit, it is nearly impossible to have a well-diversified portfolio, so be aware that you may need to invest in one or two companies, at the most, in the first place. This will increase your risk. This is where the major benefit of mutual funds or ETFs comes into focus. Both types of securities tend to have a large number of stocks and other investments within their funds, which makes them more diversified than a single stock. The bottom line. It is possible to invest if you are just starting out with a small amount of money. It's more complicated than just selecting the right investment, a feat that is difficult enough in itself, and you have to be aware of the restrictions that you face as a new investor. You'll have to do your homework to find the minimum deposit requirements and then compare the commissions to those of other brokers. Chances are that you won't be able to cost-effectively buy individual stocks and still diversify with a small amount of money. You will also need to choose the broker with which you would like to open an account. 2. Gold. All that glitters. In its physical form, the asset includes medallions such as bullion coins and the Mandela medallion. Here, one would invest in both the bullion value and the value of the coin itself. This type of investment largely trades at the bullion value plus profit, which relies on the collectability of the coins. Another alternative is the Krugerrand. With the Krugerrand, the gold price in dollars and the dollar/rand exchange rate need to be taken into account. If the rand appreciates and the gold price remains steady, investors still make money, as it hedges against both rand and dollar inflation. Getting a share. There is also the option to invest in gold shares. In this case, investors need to be aware of more than just the gold price. Potential investors should consider factors such as the exchange rate, as well as the operation/management of the mines, as these play a huge role in the profitability of the company concerned. One type of investment is not necessarily better than the other. With that said, the higher the risk, the higher the return. But conversely, the greatest risk could also lead to the greatest loss, especially if you have a short-term investment horizon. Krugerrand's gold since 31st of December 1999 has delivered a 12.7% per annum return. This is a good guideline for gold bars and the gold ETF too. 3. Real estate. When investing in real estate, the goal is to put your money to work today so you have more money in the future. The profit, or return, you make on your investments must be enough to cover the risk you take and the taxes you pay. There are other costs of owning real estate, such as utilities, maintenance, and insurance. Real estate investing can really be quite simple once you understand the basic factors of the investment, economics, and risk. You buy properties, avoid going bankrupt, and earn money through rent, all so that you can buy even more properties. But keep in mind that simple doesn't mean easy. If you make a mistake, the consequences can range from minor inconveniences to major disasters. 4 ways to make money by investing in real estate. When you invest in real estate, there are 4 main ways you can make money. Real estate appreciation. This is what happens when a property rises in value due to a change in the real estate market. For instance, the land around your property could become scarcer or busier. For example, if a major shopping center were to be built nearby. Or perhaps you made upgrades to the property that make it more attractive to buyers. Real estate appreciation is a tricky game, because it is not easy to predict. It is riskier than investing for cash flow income. Cash flow income. This type focuses on buying a real estate property, such as an apartment building, and operating it. You then collect a stream of cash from tenant rent. Cash flow income can also come from other types of real estate besides apartment buildings, such as storage units, office or retail buildings, and rental houses. Real estate-related income. This income is common for specialists in the real estate industry, such as brokers. They may make money from commissions on properties they have helped a client buy or sell. Real estate management companies sometimes get to keep a portion of rents in exchange for running the day-to-day operations. A hotel management company might keep 15% of a hotel's sales for taking care of the day-to-day operations. They may hire cleaners, staff the front desk, mow the lawn, and wash the towels. Ancillary real estate investment income. For some, this can be a huge source of profit. Ancillary real estate investment income includes things such as vending machines in office buildings or laundry rooms in rental apartments. In effect, this involves many businesses within a bigger real estate investment. They let you make money from a semi-captive collection of customers. Tips for your first property investment. There are a few ways you can buy your first real estate investment. If you are purchasing a property, you can use debt by taking a mortgage out against a property. The use of leverage is what attracts many real estate investors. It lets them acquire properties they otherwise could not afford. Using leverage to purchase real estate can be dangerous. In a falling market, the interest expense and regular mortgage payments could drive you into bankruptcy if you aren't careful. To manage risk and protect yourself, consider holding real estate investments through special types of legal entities rather than in your own name. These include limited liability companies or limited partnerships. You should consult with a lawyer to decide which method is best for you. If the investment goes bust, or someone slips and falls, resulting in a lawsuit, these legal entities can protect your personal assets. That means the worst that could happen is that you would lose the money you've invested. You will have peace of mind knowing that your retirement accounts and other assets should be out of reach. And with that, we've reached the end of this episode all about the different types of investments you can leverage. Do you invest in any of the previously mentioned? If so, why? Get involved and let us know in the comments section down below. If you enjoyed this one and found it intriguing, remember to leave a like on the video and to subscribe to Hustlers Headquarters for even more amazing videos, just like this one. Thank you for watching and we'll see you in the next one.